Okay, let's dive right in. Welcome to an explainer that's going to totally shatter everything you thought you knew about getting rich quick in the stock market. We're taking a hard, completely unfiltered look at a financial phenomenon that promises astronomical returns, but honestly, it usually just delivers absolute heartbreak. Picture this, turning $500 into $5,000 in what, just a few days? Literally, that is the exact dream that pulls millions of people into options trading every single year. I mean, sounds amazing, right? We're all scrolling, we see the wild screenshots, we watch these traders supposedly raking in huge profits, we hear these crazy stories of ordinary people making absolute life-changing money. But yeah, there's one massive problem here. Most of those hype posts, they conveniently forget to show you what happens the morning after. The internet has this wild survivorship bias, right? You only see the lottery winners, and it completely hides the devastating reality that usually hits the average trader chasing that exact same high. Because the truth? It's honestly shocking. Right around 90% of options traders eventually lose money. And frankly, a lot of them lose way more than they ever thought possible. You see, options have an expiration date. Time decay is literally ticking away, constantly working against you. If your timing is even slightly off, well, your investment doesn't just dip a little, it completely evaporates to zero. So what's going on here? Why does this happen to so many people? Is the whole market just rigged? Are options a complete scam? Or are well-meaning traders making massive mistakes they don't even realize? In this explainer, we're breaking down exactly why most options traders fail, and more importantly, how you can avoid joining that 90%. Let's get into it. All right, take a look at this. This right here is what the reality of options trading actually feels like for the vast majority. It's not the yachts and the glamour you see on social media. It's that stomach-dropping cold sweat panic when you realize you're on the wrong side of a highly leveraged trade, just watching your hard-earned cash vanish in real time. And when it goes wrong, the math is just terrifying. Look, when you buy a regular stock and it tanks, your worst-case scenario is usually just holding on to a bad stock and hoping it bounces back someday. But with options, the destruction can literally happen overnight. You wake up holding an account statement that is nothing short of a total disaster. I mean, just look at the numbers. A life-altering loss of over 25 grand is devastating enough, but check out that 99% wipeout in option premiums. That is a catastrophic failure. Unlike a stock just dipping a few points, options decay. If the stock doesn't move exactly how you thought it would, exactly when you thought it would, poof, your premium just vanishes into thin air. So let's break down the actual anatomy of a disaster like this. First up, you've got a high volatility crash. Options pricing is heavily tied to volatility. If you buy when things are crazy volatile and the market suddenly chills out, the value of your option gets crushed, even if the stock price didn't budge. Combine that with betting the wrong way on a put option, and it's a straight shot to forced liquidation. Basically, your broker forcefully sells off your positions because you've completely run out of cash to cover your massive losses. And man, the psychological toll of that moment, it leaves you completely paralyzed. You're sitting there, drinking from a literal mug of trading pain at a massive crossroads. Do you revenge trade? Try to win it all back in one crazy impulsive move, which usually just digs a much deeper hole? Or do you take a step back, swallow the incredibly painful lesson, and fundamentally rethink your whole approach? It's a choice every struggling trader eventually has to make. Because every single day, the market essentially offers you two totally different realities. On one side, you've got this chaotic, dangerous landscape driven by pure panic and plunging charts. But on the other side, a completely different vibe. It's a structured, well-lit path of steady growth and actual sustainable profit. It's calm, it's intentional, and your daily habits dictate exactly which path you end up walking down. So how do we actively avoid the trap? How do we stay on that right path? Well, first off, you absolutely have to ignore the social media hype. Just tune it out entirely. Second, lean heavily into strict due diligence. That means actually reading balance sheets, understanding market mechanics, and having an ironclad risk management plan before you ever even think about clicking buy. And third, focus on steady growth. We're talking measurable progress over time, not swinging for lottery tickets. Because true success in this space, it's all about taking it one step at a time. It's a structured climb built on serious research and crazy discipline. It is absolutely not a wild elevator ride fueled by blind luck. You see, that successful 10% of options traders, they aren't gamblers at all. They're risk managers, and they treat trading like a very serious business. So, The next time you're scrolling your feed and you get that itch to turn $500 into $5,000 overnight on some hot tip, just take a breath. Ask yourself, are you actually prepared to put in the grueling hours of due diligence required to climb those stairs? Or are you just buying a fast, one-way ticket to trading pain? The choice and the risk is entirely yours. Okay, let's dive right into this explainer. Today, we're going to unpack a critical financial trap, one that catches out so many everyday stock investors the second they try transitioning to options. Now, if you spent any time at all on financial social media lately, you know exactly what I'm talking about. You've definitely seen those flashy screenshots and the promises of overnight wealth, right? But today, we're cutting through all that noise. We're going to strip away the hype and look at the actual mathematical mechanics of what happens to most people who just jump headfirst into this world unprepared. So we're starting off with a question that might honestly cause some severe cognitive dissonance if you're just used to buying regular stocks. Think about this for a second. You do all your homework, you pick a fundamentally great company, the stock moves exactly the way you thought it would, and you still end up losing your entire investment. Seriously, $0 left. How is that even mathematically possible? Well, it brings us to section 1, stocks versus options. First, let's understand something absolutely important here. Options are not the same as stocks. When you buy a stock, you own a piece of a company. If the company grows over time, your investment can grow too. Time is your friend. But options are different. Options have a strict expiration date. That means time is literally working against you from the second you click buy. Just imagine buying a stock and your broker tells you, hey, if this stock doesn't move enough within 30 days, your investment becomes worthless. No one would buy it. But that's exactly what happens with many options contracts. It's a really harsh reality that newcomers usually just do not grasp until it's way too late. And that leads us to section 2, the ticking theta clock. Let's look at exactly how this mechanism causes so many retail traders to fail. Holding a call option that's out of the money is literally like holding a melting ice cream cone on a hot summer day, all while a massive ticking clock is right next to your ear. The closer you get to that expiration date, the faster your investment just melts away, totally regardless of how good the underlying company is. So the crucial point you have to get is time decay, which is known in the financial world as theta. Theta is basically this invisible mathematical force that slowly makes your options contract worthless. Every single day you hold that contract, a little bit of its value just evaporates into thin air. You're essentially paying a daily tax just to hold the position, desperately hoping for a massive sudden price swing to offset that tax. Which brings us to section 3, direction, timing, and magnitude. Because of this melting effect, a trader can correctly predict the direction of a stock and still lose money. Really think about that. You can be right and still lose. That's one reason beginners struggle so much with this. They just assume, hey, if the stock goes up, I win. But options just don't work that way. To win, you must be right about direction, timing, and magnitude. Miss any one of those 3 things, and you can lose the whole shebang. So naturally, we have to ask ourselves, if the math is this brutal, and the odds are literally mathematically stacked against you from the second you buy the contract, why on earth do so many novice traders willingly walk into this complex, high-stress trap? Well, the answer is in section 4, the fake guru illusion. You can find the answer all over your social media feeds. We are constantly bombarded by flashy influencers, like our fictional friend here at Trader King Flex, boasting about these massive, rapid gains. They post screenshots of 400% returns, claiming they've secured Lamborghinis. And it creates this highly dangerous illusion that options trading is a simple, easy path to massive wealth. But honestly, they're just selling you a dream so they can charge you for access to their exclusive signal groups. But look closely at the actual reality hiding behind those Discord alerts and cherry-picked profit screenshots. What you'll usually find is a completely burned-out account statement showing devastating losses, sometimes tens of thousands of dollars. This is what happens when you blindly follow these gurus. Sure, they might hit one lucky trade and milk it for content all month, but the silent majority of their followers are suffering compounding losses because they never understood the underlying mechanics of what they were actually buying. So, I want to leave you with this final thought to remember the very next time you see some online promise of easy overnight money. With options, you aren't just betting on a great company to succeed. You are running a relentless, mathematically unforgiving race against the clock. So you have to ask yourself, before you hit that buy button, are you truly equipped to beat a ticking clock, or are you just holding a melting ice cream cone and hoping for a miracle?
Welcome to this explainer. Let's jump right in, because today we need to talk about the absolute biggest account killer in the trading world. We aren't talking about unpredictable market crashes or black swan events today. We're talking about something much, much more insidious: greed.
Section 1. The illusion of early success, or really, how this whole trap begins. Picture this scenario. A trader turns $500 into $1,500. Boom! That's a neat $1,000 profit. Now, most regular investors would absolutely celebrate that. In a logical world, you take that win, you pat yourself on the back, and you stick to your strategy.
But instead of securing that win, the amateur options trader falls right into a super dangerous psychological trap. They start thinking to themselves, well, hey, if I made $1,000 this week, I can definitely make $10,000 next week. It's crazy, but they completely detach from the realities of probability and risk.
Which brings us to Section 2, Fueling the Greed in Today's Toxic Environment.
You know exactly how it is. As this trader browses social media, they are just relentlessly bombarded. You've got these fake gurus flashing burning account statements disguised as massive wins, constantly posting alerts claiming, 800% returns in a single day. And they literally prey on that feeling of early success, making the amateur feel like their initial $1,000 win was actually entirely too small.
Believing these fabricated flexes, the trader just abandons all logic. Suddenly, they start taking larger positions. They completely stop following their own rules. They begin chasing those huge gains. At this point, they're no longer trading the market, right? They are trading their own ego.
Moving right along to Section 3, Breaking the Rules and the Total Strategy Breakdown.
We can map this psychological domino effect perfectly, because this cycle happens over and over and over again. A trader wins. Their confidence grows. Because of that, their risk increases. And then, inevitably, losses explode. The entire account just disappears.
Section 4. The Inevitable Account Disaster. The stark reality here is that the market punishes unchecked greed faster than almost anything else on Earth. And that is exactly when disaster strikes. You ignore the path of steady growth and due diligence for a completely reckless gamble. Ultimately, all it takes is one single bad trade. When you are overleveraged, that one trade wipes out weeks or even months of hard-earned profits. Finally, Section 5. Amateurs versus professionals, and why we need a fundamental mindset shift to survive out there.
See, professional traders actually understand the cycle of greed. They are acutely aware of the brutal reality of risk. Therefore, professionals focus solely on consistency. They aren't trying to make 800% by tomorrow morning. They are just trying to stay in the game for the next 20 years.
Let's break it down simply. Professionals focus on consistency. Base hits, managing risk, surviving to trade another day. Amateurs focus on jackpots. And honestly, that is exactly why amateurs usually lose everything to the cycle of greed, while the pros just quietly compound their wealth in the background. So, I want to leave you with this final, critical thought before you take your next position. Take a really hard look at your own recent trades. Are you actually building a sustainable, rule-based strategy, or are you just getting temporarily lucky, just waiting for the inevitable moment when the market punishes your greed? Thanks so much for joining me for this explainer, and remember to trade smart.
Welcome back to The Explainer. Today we're doing a bit of a trading autopsy. We're going to break down the exact mathematics of destruction that, quite frankly, completely wipe out so many newcomers in the markets. If you've ever watched a trading account just evaporate and wondered where it all went wrong, well, you're in exactly the right place, because we're going to expose the hidden mechanics behind those absolutely massive losses. So why do most traders fail? It's the million-dollar question, right? Literally. What actually separates that tiny fraction of folks who consistently pull money out of the markets from the vast majority who end up losing everything? You might think it's all about having a crystal ball, or finding some secret indicator, or perfectly predicting the news. But the reality is actually far more mathematical and, honestly, way more controllable than any of that. I mean, just look at the sheer visceral panic here. The heavy sweat, the panicked eyes, holding onto a coffee mug literally labeled trading pain, and holding a call option that's melting away right in front of him, kind of like an ice cream cone in the summer sun. And looming in the background, that massive theta clock just ticking down. This right here is the absolute reality of time decay in the markets. As time passes, the value of that contract just melts away, and it puts this immense, crushing psychological pressure on the trader. Okay, let's dive into this. While that ticking theta clock represents serious market pressure, it actually isn't what's killing the account. The market is just doing what the market does. Here's the real reason most traders fail. The hidden killer is terrible, fundamentally flawed, poor risk management. So let's look at the actual math of destruction. Let's say a trader has a brand new $5,000 account. They're super excited, they're glued to the charts, and they spot what they think is the absolute 100% perfect setup. Now, instead of risking a small, sensible percentage of their total capital on this play, say maybe 1 or 2%, this beginner gets completely blinded by the dollar signs. They get aggressive. They throw $2,500 into a single, highly leveraged melting trade. Think about that for a second. That is 50% of their entire account. They literally just risk half of their total trading capital on one single, totally unpredictable move. It's basically a coin flip, but they've got half of their net worth sitting right there on the table. And this brilliantly illustrates the absurdity of it. Half of everything they have is locked up in one single idea. That leaves absolutely zero room for error. If the market just sneezes in the wrong direction, or if that clock ticks just a little too long, they are completely exposed. There's just no safety net here whatsoever. Just one bad move, and half their capital is gone. Vanished. In a split second, they drop from $5,000 straight down to $2,500. And here's where the math really gets you. Just to get back to break even, literally just to get back to where they woke up that morning, they don't just need a 50% gain. Because of how the math works on that smaller balance, they now need a massive 100% return on their remaining capital just to claw their way back. And this triggers a really swift, really brutal sequence of events. Step 1, the massive loss hits. Step 2, desperation sets in. The trader inevitably starts revenge trading, desperately trying to quickly win back what they just lost, which usually means taking on even more uncalculated risk. And then, step 3 is the inevitable conclusion. Just a few losses later, the entire account is completely destroyed.
Section 1. The Professional Mindset Shift. How Veterans Survive. So, if beginners wipe themselves out by risking half their accounts like that, how exactly do the pros survive decade after decade in the exact same market conditions?
Well, it all comes down to the primary question they ask before they ever even click the buy button. Beginners, they always ask, how much can I make? They fixate entirely on that massive payout. But professional traders, they think completely differently. Pros ask, how much can I afford to lose? And that one small difference, it literally changes everything about how you manage a portfolio.
So the crucial point is that successful trading isn't actually about hitting home runs. It's really just about surviving. Surviving long enough to let the probabilities work in your favor over hundreds of trades rather than just blowing up your entire account on trade number 1.
Seriously, if you take away only one thing from this explainer today, let it be this universal law of trading. Protecting capital is more important than making money. It's absolutely crucial. I mean, if your capital is intact, you can always trade tomorrow, right? The opportunities are always going to be there. But a debt account, that cannot generate returns. Because ultimately, if you lose your capital, the game is over. The charts will keep ticking, the clocks will keep winding down, but you're out of the arena. So I'll leave you with this question to completely reframe your approach to the markets tomorrow morning. Are you simply playing to win that one big jackpot? Or are you actually playing to survive?
Welcome to this explainer. Look, if you're even slightly interested in the markets, you know exactly how this goes. You open social media and boom, you're hit with endless profit screenshots. You know the ones. A trader made $20,000 while you were just, eating breakfast. Someone else magically doubled their account overnight. Another trader claims they literally never lose, just posting green day after green day. And let's be real, it's completely designed to trigger your FOMO, that fear of missing out on what looks like the easiest money in the world. You sit there wondering, wait, am I the only one not getting rich here? But today, we're going to tear down that facade. We are exposing the massive, massive disconnect between that curated feed and the hidden reality of actual trading.
Okay, let's dive right into this contrast, because it really is everything. Online, it's just this nonstop parade of huge profits, zero losses, and doubled accounts. It's entirely designed to look completely effortless. But here's what you rarely see: the losses, the blown accounts, the failed trades, the months of agonizing frustration and stress. Social media creates an incredibly potent illusion. It essentially hides the grueling, brutal reality of trading behind this shiny filter of instant gratification, and it makes the impossible seem like an everyday occurrence. And honestly, staring at that manufactured reality naturally brings up a really tough question.
It's the exact question this illusion creates in the minds of beginners. Why is everyone winning except you? If you have ever felt that way, I just want to validate your frustration right now. It is completely normal to feel left behind when you're constantly bombarded with everyone else's highlight reel while you're just sitting there alone with your own behind-the-scenes struggles. You got to realize this happens because of survivorship bias. You are literally only seeing the lottery winners. The thousands of people who lost their entire savings today, yeah, they aren't posting about it. So hear this, you are not alone, and absolutely everyone is not winning.
Section 1. Fake gurus, real losses.
Now, what's really interesting about this is the devastating reality behind those flashy Discord alerts. You know, the ones boasting 800% gains and tweets shouting, "Lambo secured." Often, the guru is selling an absolute dream to their followers, while their actual mathematical trading reality is quite literally going up in flames. We're talking about a hidden monthly statement showing a massive $25,000 loss. They project this image of total invincibility just to gain your trust. But here's the critical insight. The real business isn't trading. Their business is selling you a subscription. They don't actually need to be profitable in the markets if they have thousands of beginners paying them monthly fees.
The bait? It's always exactly the same. Plus 120K day. Easy money. Join my Signal group. We've all seen a post exactly like this, right? They aggressively frame massive, highly improbable windfalls as just easy money. They know beginners are desperate to bypass the hard work of learning, so they prey on that exact vulnerability. They frame it so that anyone can achieve this luxurious lifestyle effortlessly, as long as you pay their $99 a month VIP fee, of course. It's a calculated psychological trap, pure and simple, designed to siphon capital from the hopeful right into the pockets of the marketers.
So we have to remember the fundamental rule of this space. People only post their winners. Very, very few share their disasters. This social media ecosystem creates a dangerous feedback loop that makes beginners believe huge profits are normal. Spoiler alert, they're not. When you are fed a daily diet of six-figure gains, a solid 2% return suddenly starts looking like a total failure. Buying into the idea that effortless home runs happen every single day, that is the very first step toward blowing up your own account, because it fundamentally warps your understanding of how markets actually function.
Section 2. The silent account killers.
Behind the scenes, beginners who buy into the illusion are falling victim to misunderstood market forces. I mean, just imagine holding an options contract that is melting away like an ice cream cone on a ridiculously hot summer day. The clock is relentlessly ticking down, the sweat is pouring, and sheer panic is setting in. Every single second that passes, the value of that position decays. The closer it gets to expiry, the faster the money just vanishes into thin air. It is a terrifying, visceral feeling of absolute helplessness as the market just bleeds the account dry.
To put a name to that melting ice cream, we really need to talk about theta. Theta, or time decay, is the relentless mathematical process that decreases the value of an options contract as the expiration date gets closer. Think of it kind of like a grocery store coupon. As it gets closer to its expiration date, its likelihood of being used drops and its value just completely drains away. Look, the market doesn't care about your feelings, and it definitely doesn't care if you eventually guess the right direction of the stock a week from now. If the clock runs out before the move happens, your capital evaporates. It's a silent killer that these gurus deliberately ignore when they're selling you their dream.
Then there is the absolute visceral nightmare of bad risk management. It's like watching an account literally get sucked into a massive red black hole right on the trading desk. Capital drains away down to pennies while the trader just grabs his head in despair, totally surrounded by error screens and crashing charts. And the thing is, this isn't just one bad trade. This is what happens when there's a complete lack of a safety net. Without strict rules limiting downside loss, it literally only takes one moment of stubbornness or panic to vaporize months of hard-earned savings.
So the crucial point here is this. When traders compare themselves to unrealistic expectations, they start taking reckless risks. They feel utterly inadequate watching their social media timeline. So to catch up to those fake gurus, they throw their safety harnesses straight out the window. They bet way too much on a single highly speculative trade, just hoping for a miracle to bail them out, and that usually ends badly. It ends right in that red-black hole we just talked about. The illusion directly fuels the exact recklessness that destroys beginners. Section 3. Professional Trading Reality.
You see, the amateur mindset is all about the rocket ship. It's chasing overnight wealth, strapping yourself to a bomb, and taking massive, outsized risks just to try and double an account by Friday. It's built entirely on hope and adrenaline. But professional reality, it's entirely different. It's building a staircase, brick by brick, under the protection of an umbrella. It's not flashy, and it for sure won't go viral on social media, but it weathers the storm. Professionals focus heavily on capital preservation over rapid appreciation. They know that survival is the ultimate metric of success in the markets.
Let's summarize the core truths of this reality check. Professional traders often target small, consistent returns. They strictly manage risk on every single trade and view losses simply as the cost of doing business, not some devastating personal failure. They know exactly how much they are willing to lose before they even enter a position. The flashy gains you see online are usually exceptions, not the rule. True longevity in this space comes entirely from avoiding the social media illusion and sticking to a fiercely disciplined, mathematically sound, boring plan.
Which leaves us with one final, absolutely critical question as you step back out into the financial world. Will you chase the illusion and pay for someone else's lifestyle, or will you manage the risk and build your own? The market doesn't care which one you pick, but your future account balance definitely does. Thank you for joining me for this explainer. I really hope this helped clear the smoke, and I'll see you in the next one.
Let's talk about a silent killer. Imagine checking your brokerage account first thing in the morning. You're expecting to see green, right? Because the stock you've been obsessively tracking is holding perfectly steady. But instead, you log in and your balance is just bleeding out. It's a gut-wrenching feeling. There's a force out there draining trading accounts completely under the radar. Welcome to today's explainer, where we're going to expose exactly what this invisible force is, how it works, and most importantly, how to stop it from eating your portfolio alive. It's an incredibly disheartening scenario. Traders wake up confused. The stock barely moved, yet their option lost money. Think about that for a second. You did all your research. You picked a direction, and the market didn't even go against you. It literally just went sideways. Yet you wake up, you log in, and your position is down 20, 30, or even 50%. It feels incredibly unfair, doesn't it? It kind of feels like the whole system is just rigged against the retail trader. Which brings us to the million-dollar question. Why did your option just lose money? You're staring at the screen, furiously refreshing the page, probably thinking maybe your broker is glitching or there's some sort of massive Wall Street conspiracy working against you. You bought a call, the stock didn't drop, so why on earth is your account balance in the red? Well, I hate to break it to you, but this isn't manipulation. The truth is actually much colder, entirely predictable, and rooted in pure mathematics. We are talking about theta decay. This is absolutely one of the most misunderstood concepts in all of options trading. Here's the deal. Every single day that passes, an option loses value, even if the stock barely moves. It's simply how options are designed. When you buy an option, you're essentially buying a limited window of time for a stock to make a move. And as that window starts to close, the value of that time just evaporates. And here's the kicker. That evaporation actually accelerates as you get closer to expiration. Imagine buying ice cream on a sweltering hot day. If you don't eat it quickly, it just melts all over your hands, right? Well, options work exactly the same way. Say you've got a $155 strike price that expires tomorrow, and you paid a $4.50 premium for it. Because that expiration is so incredibly close, it's like a massive clock ticking down to zero. As expiration approaches, that time value melts away. Many beginners buy cheap options because, well, they seem affordable. But cheap options often expire soon. That means theta decay can destroy their value rapidly. And what's really insidious about all this is how this widespread lack of understanding makes beginners the absolute perfect target. There is an entire industry out there, all over social media, completely built on selling you expiring dreams. They prey on that very human desire for quick riches, and they weaponize the complexity of options pricing right against you. So let's compare the fantasy they sell with the brutal reality of the situation. On one hand, you have what these so-called gurus post. We're talking claims of 800% easy money and flashy pictures of brand new Lamborghinis. They sell this super alluring idea that you can just buy dirt cheap, short-dated options, follow their secret alerts, and strike it rich overnight. But then there's what actually happens. Sudden and catastrophic account drain. When you buy cheap options that expire in a few days based on some guru's alert, you aren't investing. You are fighting a massive, mathematically impossible uphill battle against time. Let's unpack the stark reality behind those flashy Discord signal alerts that are always popping up. Someone is boasting about making huge gains on sold calls, right? Well, here is the dark secret. The gurus are very often the ones actually selling the very options that you are buying. They are safely collecting that premium while you are left holding the melting ice cream. It's a devastating reality, like watching your monthly account statement literally go up in flames. And it plays out every single day for traders who outsource their thinking to social media influencers. Think about a number like -$25,432. That is not some paper trading simulation. That is real, hard-earned money completely gone. Poof! Understanding time decay is absolutely critical, and ignoring it is incredibly expensive. When you blindly follow signal alerts into short-term options, theta decay transforms from this abstract math concept into a very painful, life-altering financial loss.
But listen, we can't just blame the fake gurus forever. At a certain point, we have to look in the mirror and take accountability for our own capital. Because ultimately, no one forces you to take a trade. The person clicking buy and exposing that capital to the ultimate culprit is you.
And this brings us to the ultimate, unforgiving account killer. This isn't just about theta decay anymore. It is about bad risk management. Imagine your trading desk literally collapsing into a glowing red black hole, just sucking your capital dry, leaving you with a meager remaining balance of maybe $4,500. That is the direct, unavoidable result of combining a misunderstanding of theta decay with terrible risk management. Betting way too much of your portfolio on a single short-term trade, failing to cut your losses, and letting hope replace strategy, that will pull your entire financial future right into the abyss. The market doesn't care about your hopes, guys. It only executes your errors. So how do we fix this? How do we actually survive and thrive out there? Well, here are your absolute, non-negotiable rules to survive. First, understand time decay. Know that time is a relentless enemy when you are buying options. You have to factor that into every single trade. Give yourself enough time until expiration for your thesis to actually play out. Second, ignore fake gurus. If someone is on social media promising you easy 800% gains on weekly options, mute them, block them, and run the other way. And third, practice strict risk management. Never, ever put a massive chunk of your account into highly volatile, short-dated contracts. Protect your capital first and grow it second. Which leaves us with a fundamental choice every single time we log into our brokerage accounts. Are you trading on math, or are you just buying melting ice cream? The next time you look at a seemingly cheap option that expires on a Friday, I want you to remember that giant ticking theta clock. Remember the burning account statement and that terrifying black hole of bad risk management. Take control, respect the math, and fiercely protect your capital. Thank you so much for joining me on this explainer. I really hope it saves you some serious capital, and I'll see you in the next one.
Welcome back to another explainer. So today we're looking at something literally every single person who has ever clicked buy or sell in the financial markets absolutely needs to understand. I mean, we spend so much time analyzing charts, right? Drawing trend lines, backtesting these super complex algorithms. But today, we're skipping all of that. We're going to focus on the real battleground, the hidden psychological traps of trading. We are unpacking the exact anatomy of how a perfectly good account just goes up in flames.
Negative $25,432. Yeah, that is not a paper trading glitch. That's a real, devastating, pit-in-your-stomach account loss. Just imagine logging in and seeing that red ink staring back at you. You get the cold sweat, the immediate panic, that sudden realization that months, or man, even years of hard work have just vanished in the blink of an eye. Which naturally brings us to the ultimate question, doesn't it? How does this happen? How does a trader, equipped with a smart strategy, totally solid indicators, and a seemingly rational mind, end up facing a catastrophic loss like that? Well, I'll give you a hint. The answer doesn't lie in the candlestick charts, and it certainly doesn't lie in the moving averages. It actually lies entirely in human behavior.
Section 1. The easy money illusion. This is exactly where the trap is set.
You see, the modern retail trading environment is built on this incredibly dangerous contrast. On one side, you have these fake gurus and flashy Discord alerts screaming about easy money and plus 800% returns, promising these crazy luxury lifestyles. But the reality? It's traders sweating, panicking, holding account statements that are literally on fire from devastating losses. These fake profit screenshots out there, they just lure everyday people into a totally false sense of security. Because the industry sells a very specific promise, right? That you can just effortlessly pull 800% gains out of the market from your smartphone while sitting on a beach somewhere. But the agonizing reality for most folks who buy into that hype is massive, crippling, unrealized losses. That glamorous social media narrative, it directly fuels terrible decision-making because it completely removes the very concept of risk from a beginner's mind.
Section 2. The real account killer. Primitive emotions.
Here's the truth. Most trading losses don't happen because of bad strategies. They happen because of emotions, fear, greed, hope, revenge. These four emotions will destroy your portfolio way faster than any market crash. The market, it doesn't care about your feelings, your rent payment, or your ego. And when a trader fails to manage these emotions, well, their strategy just goes right out the window.
But out of those four, one is uniquely destructive. A trader loses money. Instead of stepping away, they immediately place another trade. They want their money back, fast. This is called revenge trading, and it's incredibly dangerous because the moment you try to punish the market, I promise you, it usually punishes you 10 times harder.
Section 3. Anatomy of Revenge Trading. Let's look at this psychological spiral.
So, how does it happen? First, you take a normal loss. It stings, sure, but it's part of the game. Second, the anger sets in. Your heart rate spikes. Third, all your predetermined rules, they just disappear. Stop losses get ignored. Position sizing is completely forgotten. And finally, you hit the breaking point. You place a massive, oversized trade to win it all back in one desperate swing.
And because that massive revenge trade was placed purely on frantic urgency, it usually fails. The trader becomes emotional, rules disappear, risk increases, mistakes multiply. Soon, one loss becomes 5, 5 becomes 10, and the account collapses. At this point, you're no longer trading. You are literally just gambling while on tilt.
Section 4. The black hole collapse, the inevitable end.
You see, bad risk management is a silent killer. When those screens flash red and the desk shatters, your remaining balance is violently sucked into what's basically a literal black hole. Once your discipline breaks, your capital is pulled into this vortex that you simply cannot escape from. Not until the balance hits zero.
Section 5. Reaction versus execution, the disciplined reality.
Because the truth is, the market doesn't care about emotions. It rewards discipline. The traders who survive are usually the ones who stay calm during wins and losses. They don't celebrate wildly when they make $1,000, and they certainly don't smash their keyboards when they lose $1,000. The crucial distinction boils down to this. Emotional traders react. Professional traders execute. That's a huge difference. An amateur feels the pain of a red screen and reacts defensively, trying to fight the tape and, force a result. But a professional sees the exact same red screen, accepts the data, and simply executes the next step in their pre-planned system. No anger, no hope, just pure execution.
Which leaves us with a pretty heavy question, one you absolutely have to ask yourself every time you sit down at the charts. Next time the market takes your money, and let's be real, it will take your money eventually, will you fight back out of anger, or will you have the iron discipline to simply close the laptop and walk away? Because the answer to that question determines whether you keep your capital or whether your account just becomes another casualty swallowed up in the black hole. Thanks so much for joining me on this explainer. Keep your mind sharp and keep your risk tight out there.
90%. Just kind of sit with that number for a second. 90%. It's an absolutely massive, staggering statistic. Think about it. If I told you there was a 90% chance the airplane you were about to board was going to crash, or a 90% chance your car would break down on the highway today, there's no way you'd get in, right? You wouldn't even consider it. Yet, every single day, thousands of people eagerly dump their hard-earned money into a system where this exact failure rate is just the documented norm.
If you've ever seen those charts plummet aggressively into the red and it feels like your trading desk is literally on fire, man, you've felt the harsh reality of options trading. Actually, if you've ever watched a position completely go against you, you know the feeling. Your heart races, your stomach drops, and you just feel entirely helpless as your capital literally vaporizes right in front of your eyes. It's a visceral, deeply painful experience, and unfortunately, it's the harsh reality for the vast majority of retail traders out there. So if you've been there, you are absolutely not alone in that pain.
Okay, let's dive right into today's explainer. We're going to be answering a literal multi-million-dollar question. Why do 90% of options traders lose money? And, more importantly, how can you make sure you're in that top 10%?
Now, what's really interesting to note here is that glowing red sinkhole just swallowing a trader's account. It's not always the big, bad market makers out to get you, and honestly, it's not even always bad stock picks. The real truth, the one that no so-called guru really wants to admit, is that bad risk management is the silent account killer. It's this invisible force secretly, systematically draining retail accounts dry.
And this brilliantly illustrates what happens next. A devastating minus 85% unrealized loss staring back at you. Your hand is just hovering over that giant buy-call button, totally frozen in panic. This right here, this is the absolute emotional and financial destruction of just one single, poorly managed trade. It's that one massive gamble where a trader goes all in, swinging for a home run, and instead, they just blow up weeks or maybe even months of hard work in an instant.
So, stripping away all those flashing red lights and dramatic moments for a second, let's look at the actual underlying mechanics. Let's shift away from the emotional pain and get a bit more clinical with our analysis. So, why do 90% of options traders actually lose money? Well, because they make these 6 huge mistakes. They chase quick riches, they risk way too much capital, they completely ignore risk management, they don't understand theta decay, they just blindly follow social media hype, and they let emotions control their decisions. Actually, I want to pause on that 4th point for just a second, because it's a silent killer all on its own, and it's totally unique to options: theta decay. See, unlike buying regular stock, options are expiring assets. Think of an option contract kind of like an ice cube sitting on a hot sidewalk in the middle of summer. As it gets closer to its expiration date, its value automatically drops just because time is passing. Yep, even if the underlying stock price doesn't move a single inch. If you don't fully grasp how time literally eats away at your money, believe me, the market is going to gladly take it from you.
Now, if you're listening to this and realizing you've made these exact mistakes, just take a deep breath. Because here's the really good news. Most of these mistakes are completely avoidable. Seriously, none of these are unavoidable acts of nature. They're just behavioral choices, which means you absolutely have the power to change your approach starting today.
Let's move to how this builds, because there's this huge myth out there about what actually makes a winning trader. The myth is that successful traders are somehow smarter than everyone else. The reality? The traders who succeed aren't necessarily smarter. They're simply more disciplined. Winning in options isn't about perfectly predicting the future like you have some sort of crystal ball. It's all about emotional control and unwavering consistency.
That elite 10%, they survive and thrive because they follow 3 highly rigorous steps. Step 1, they protect their capital. Look, if you lose your chips, you literally can't play the game anymore. Step 2, they manage risk. Position sizing is everything here. You can never ever put yourself in a situation where one bad trade just completely wipes you out. And step 3, they stay patient. They sit on their hands and wait for those A-plus setups. You really don't have to swing at every single pitch the market throws your way. So, the crucial point is, how do you fundamentally view the market? The 10% who consistently succeed understand deep down that trading is a marathon, not a lottery ticket. They're pacing themselves. They're focusing on steady, incremental progress rather than this immediate, exhausting sprint to the finish line. A sprint that almost always leads to a catastrophic account blowout.
I really want you to remember this because it perfectly sums it all up. The goal isn't to get rich in one trade. The goal is to stay in the game long enough to build consistent profits. If you can just manage to avoid the common mistakes that destroy most retail traders, you're already leaps and bounds ahead of the majority. Because consistency, that is the true holy grail of trading.
Well, if you enjoyed this explainer and you want more on the stock market, options trading, investing, and general wealth-building strategies, be sure to hit that like button, subscribe to the channel, and turn on those notifications. So I'm going to leave you with this final question to think about. Are you going to keep playing the lottery tomorrow, or are you finally ready to start running the marathon? Thanks so much for hanging out with us, and I'll catch you in the next explainer.